Today we're going to talk about two top ETFs that have taken the US market by storm and have recently launched in Canada. This one's for all you income seekers out there who want to maximize your yield. I'm talking about JEPI and JEPQ. They're offered by JP Morgan, but which one's right for you? Let's find out. First up is JEPI, which stands for the JP Morgan Equity Premium Income ETF. And this has quickly become a fan favorite among income and dividend investors out there. It has amassed close to $37 billion in assets under management. Why does this stand out from the crowd and why should you be interested in JEPI? Well, let me tell you why. First, during the 2022 bear market, it showed strong performance. Even though the S&P tanked by around 18%, this ETF only lost 3.5% value. Plus, you get monthly distributions. And I know this is a top priority for you income seekers out there, is getting monthly passive cash flow. So it checks that box as well. And not only that, it's giving you that monthly income. It's giving you strong performance during a bear market, all for a low expense ratio of only 35 basis points. Comparable ETFs in the segment will be charging you 100 basis points, 200 basis points. So you're getting this for a fraction of the cost. And last but definitely not least, the reason you're watching this ETF is because of a high dividend yield of around 7%. But wait, there's more. I mentioned two ETFs. The other ETF that we're going to talk about is JEPQ, which is sort of the lesser known cousin of JEPI. JEPQ is the JP Morgan NASDAQ Equity Premium Income ETF, and it uses a similar strategy of JEPI, but uses a different stock composition. Both JEPI and JEPQ have a clever strategy that generates that extra income. And that's because they sell covered call options on their indexes, which are unlikely to be exercised. But there's also a twist in how they operate. Instead of owning every single stock in that index, what they use is something called an equity linked note, which is called an ELN. And effectively, what it does is that it replicates the same level of risk, the same level of return, but without holding all the underlying assets. What's really interesting is how they choose their investments. Both ETFs are actively managed, and they pretty much handpick their selection of stocks from their respective indexes. JEPI is going to track the S&P 500, where JEPQ is tracking the NASDAQ. The point of this video is to help choose, is JEPI better for you or is JEPQ? But in order to talk about that, let's talk about first why they're so similar. So here are three key reasons why you want to potentially consider JEPI or JEPQ as part of your portfolio. First of all, you're going to capture most of the benchmark returns. What that really means is that you get to benefit from the S&P 500 performance and the NASDAQ without actually having to mirror that exact index. Secondly, both these ETFs aim for lower volatility than their benchmarks. As I mentioned earlier in the video, for example, back in 2022, when the S&P 500 dropped 18%, the JEPI ETF only lost 3.5%. So the goals of these ETFs is sort of smooth out the ride between the ups and downs. And third, why you're watching this video is because you want that monthly passive income delivered to you on a routine basis without having to think what the market is doing. As long as you're getting your dividend paycheck, whether the market is up or down, doesn't really matter to you. You're getting what you want, and it's that sweet dividend cash flow. Now, there is a little caveat because if something sounds too good to be true, it typically is. So there is a big caveat when it comes to pretty much any covered call ETF, in that, as I mentioned, they generate extra income because they're selling covered call options. When you sell covered call options, you're pretty much limiting your future upside potential, meaning you're not going to see as much capital appreciation as you would have if you had an ETF that doesn't have covered call options. So what I'm getting at, there is a bit of a trade-off. You can either earn more money now, more income, but you're giving up larger future capital gains. So if you're not interested about total return and future capital gains and capital appreciation, and you want that income now, consider that to be a trade-off. What are you really interested in? What is your financial objective by investing in these ETFs? And if it makes sense that you want that income, but not that much interest in that future upside, then sure, consider these two options. So now that you know why they're so similar, what makes them different, and this is what's really going to help you determine whether you should select JEPI or JEPQ. The main difference really comes down to the benchmark that they choose to follow. JEPI, you're getting the S&P 500, and JEPQ, you're getting the NASDAQ. And if you don't know what the S&P 500 is, it pretty much means that with the S&P 500, you're going to get broad-based market exposure of the 500 largest and mid-cap companies. That means JEPI can tap into a diverse mix of big, established firms and medium-sized companies over various industries. That's the S&P 500. The Nasdaq, on the other hand, is the 100 largest non-financial stocks listed on the Nasdaq exchange. And this NASDAQ index is famously going to feature the tech heavyweights and the titans of communications technology. Because of this, these two ETFs have notable differences in terms of the companies and the size of companies and the sector those companies are in, they invest in. So if we had to do a side by side, JEPI is going to give you higher proportion of mid-cap stocks. This gives you a broader reach across different sectors, offering you a mix of stability and growth potential. JEPQ, on the other hand, has minimal exposure to sectors like materials, financials, real estate, utilities, and energy. Instead, what you're getting in place is a heavy dose of tech and the communication sector. So if you're going to add JEPQ to your portfolio, essentially you're making a big bet on the tech sector and the ongoing digital revolution. And keep in mind, the tech sector is a double-edged sword. So even though it offers up higher potential for gains, you could also lose as much with a larger downside. So now that you understand how JEPI and both JEPQ operate, what are the similarities between the two, what are their differences, let me show you how to actually add them to your portfolio. So for this example, I'm going to show you Wealthsimple. I'm going to show you how you can actually add these two ETFs to your portfolio as soon as you watch this video. And keep in mind, you don't have to use Wealthsimple. You can use any other brokerage you want to, whether it's Questrade, Qtrade, Interactive Brokers, doesn't really matter. I'm just showing you as an example of how you can use whatever brokerage you want to actually add JEPI or JEPQ to your portfolio. So first, in this case, I've already logged into Wealthsimple, and I'm going to search for the symbol, starting off with JEPI. Now you'll notice in this case, there's two options. There's one that says NYSE and the one that says TSX. For this particular example, I'm looking for the one that trades on the TSX because I don't want to pay foreign currency exchange between Canada and US every time I pick up US units of JEPI. So what you want is this TSX option right here. And once you click that, you can see right now we have JEPI. Here's the name, JP Morgan US Equity Premium Income Active ETF. Always a mouthful to say. And as of right now, you can see it's trading roughly around just under $27 a share. If I were to zoom out, it started off trading for 25, so it's already seen a decent amount of capital appreciation since launching back in September of 2024, going from 25 per share to now 26.49. And the cool part is you've been collecting a 7% yield on top of this capital appreciation. And if I scroll down, you can see some market details about this particular ETF. This is what you want to pay attention to, is you want the one that trades on the TSX if you want to avoid foreign currency impact. It's trading for, you can see the high, the 52-week low. You can see the volume. And the other piece I want to caution you, I've mentioned 7% yield. So why are you seeing a yield of less than 1%? And that's because this ETF just recently launched, so it hasn't had a full year of dividends to properly calculate a yield. So what you're seeing is a yield that only shows maybe a handful of distributions. After a year has passed, this yield of 0.95% will be much closer to the 7% range, which is where the US one trades at. One is, don't be concerned about this 95 basis points. That's not the true yield because it has just recently launched. You can see already launching in a short time span, it has already amassed $88 million in terms of market cap. And you can also see that the average volume for this ETF is over 10,000. What that shows you is every time an ETF is above that 10,000 mark, That means it's a very popular ETF. That means a lot of investors are actively seeking to add or sell this ETF as part of their portfolio requirements. So that is JPI in a nutshell. Same thing, if you want to add JEPQ, you're just going to punch in the name JEPQ, and you'll notice that there's two options, NASDAQ and TSX. So what you want is a TSX option. Once you click that, you will see the name JP Morgan NASDAQ Equity Premium Income Active ETF. And right now, it's trading for $28.41. This is key right here. You want the one in Canadian dollars, so you're not having to pay foreign exchange fees. And here are some more market details. I won't go over the same. You can see pretty much the high, the lows. The exchange is an important one, TSX. Don't be concerned about the yield because same thing with JEPI. It hasn't seen a full year yet. And the average volume for this one is much higher at over 25,000 with a market cap lower than JEPI at 52 million. What that shows you is both these ETFs are super popular for income seeking investors. And how do you add these two ETFs to your portfolio? Well, with Wealthsimple, it's fairly easy because I'm on the buy toggle. I'm going to select market buy, and then I can punch in whatever shares I want. So if I want 10 shares as an example, it'll cost me $284. If I want 100 shares, I'm paying roughly $3,000 to invest. I can choose whichever account I want to invest in, whether it's non-registered, your TFSA, your RSP, you can pick whatever. And if you have the cash, just click on the next button and you're pretty much good to go. In this case, I don't have enough money, so if I wanted to buy the 3,000, if I want to make that $3,000 investment, I would have to transfer money to my non-registered in order to make this purchase of 100 units. Same concept for JEPI. Go on the buy toggle, choose your order type. In this case, it's market buy. Choose your number of shares, 1, 10, 100, 5, doesn't matter. You can pick whatever amount you want, and then just click on next, and it'll be added to your portfolio. So now that you know how to add JEPI and JEPQ to your portfolio, how do you know which one to buy? In other words, how do you know, or how should you determine how much to invest in each of these? You saw me in this example, punch in 1 share, 10 shares, 100 shares, but how do you really know how much of each of these ETFs to actually add to your portfolio? And that's what we're going to talk about next. This is where financial modeling comes into play. And if you've been following my channel all along, you're going to see this spreadsheet that's very familiar to you, and that's how I model how much to buy in what ETF. So let's take a look at that spreadsheet. And by the way, if you are interested in a copy of the spreadsheet, it is in the link down below, so you can grab a copy, download it yourself, and then play around with it. As you can see, I've already loaded it in JEPI and JEPQ into my financial model. I can see the current price. I can see the yield is between 7 to 9%, 7 to 10%. I can see how much I can expect on a monthly basis in terms of 16 cents per share for JEPI. Again, this is an average because these ETFs have not traded for a full year, so I'm just using an average for financial modeling purposes. And here's the real cool part. This shows you how much you have to invest in each ETF to generate $1,000 a month, $2,000 a month, or $3,000 a month. So for example, if you wanted to make $1,000 a month in passive income, you would have to invest around $125,000 into JEPQ. And if you want to generate $3,000 a month with a bit of a lower yield and JEP as your option, then you're looking at an investment of just under $500,000, so you can generate monthly passive income of $3,000 a month. In this case, I'm looking to generate max amount of income. I'm going to choose 50% into JEPI and 50% into JEPQ. And my starting investment is $10,000. So what this shows me is that with today's market price, I'm looking at about 186 shares for the first one and 176 for the second option. That means my income generation from JEPI will be $30 a month, and my income generation will be $40 a month from JEPQ. That gets me a total monthly income of just under $71 a month, and that's with 362 shares. Again, my investment is $10,000. That means on an annualized basis over 12 months or a full year, I'm looking to make around $850 a year, and that translates into a hybrid yield of 8.5%. And this is what I do for my financial modeling when I'm looking at, okay, which ETF do I want to invest in? How much shares of each ETF do I need to buy? I'm sort of working backwards because I'm taking a look at, okay, how much money do I want to generate on a monthly basis? How much money do I have to invest as a starting point? And then you can play around with this. So instead of 10,000, if you have a much smaller amount, like $1,000, same thing, 50% target. But maybe you want to tilt more towards the S&P 500 option. So 60% here, 40% here. And in this case, with $1,000 to invest, 60% towards JEPI, 40% towards JEPQ, you're looking at 22 and 14 shares respectively. I'm generating about $3 to $4 a month with a total of just under $7 a month with a $1,000 investment. That makes me just about $83 a year with a return or with a yield, a dividend yield of just over 8%. And if you download the spreadsheet today, I've also included alternatives. So you don't have to go with JEPI, you don't have to go with JEPQ, but there are other options that are sort of in the same vein, and you can play around with the same type of option. Maybe instead of JEPI or JEPQ, you're interested in HYLD, HDIV, or HMAX. So you can play around with these different options, play around with different scenario planning, and figure out what makes sense for you and for your financial journey. So to sum it all up, if you're looking for consistent monthly income with lower volatility than investing in the S&P 500 or the NASDAQ, then these two ETFs might make sense for your portfolio. And on the flip side, if you're chasing total return, you want as much capital appreciation as possible, then these two ETFs may not make the most sense for you, and you might be better off with something like a VEQT or an XEQT for global diversification and maximum total return with a one-click solution. Having said all that, I'm actually a big fan of how JEPI and JEPQ operate. They use a data-driven approach. They add in that extra layer of active management, but all at a low-cost option at 35 basis points for the expense ratio. They're offering monthly income. So that's why, personally, I'm very interested in these two ETFs. When it comes to these two ETFs, it's an interesting blend of tracking two well-known indexes, but layering on covered call options, data-driven approach. It makes for an interesting financial journey. And it's something for you to consider because it just might change the way you think about investing your own hard-earned dollars. The goal of this video is to help you understand the nuances when it comes to these covered call options so you can make more informed decisions with your hard-earned dollars. If you've enjoyed this video, make sure you hit that like button, make sure you hit that subscribe button, and turn on notifications so you don't miss out on future content. And I have a whole bunch of resources for you in the description below, from the spreadsheet that you saw in this video to a whole other options. Make sure you check them out right now. They're in the description for you to check out. Last but not least, leave me a comment. Let me know your thoughts about JEPI or JEPQ, or maybe there's other covered call ETFs that you're considering that you're not sure of. Let me know your thoughts. I'd love to hear from you. I read every single comment. That's it for now. I'll talk to you in the next one.